If you're looking for safe income-generating stocks in an uncertain market, there are a couple of real estate investments that might be exactly what you need. In this video, I will walk you through 2 REITs that have stood the test of time. First, we'll take a quick look at what these companies actually do. Then we'll dig into their finances, and finally I'll estimate what a fair buying price might be for each one with different returns. Quick overview. First company is Realty Income, ticker O. Realty Income is known as the monthly dividend company. They own over 13,000 commercial properties across the US and other countries, mostly leased to large stable tenants like Walgreens and 7-Eleven. The key here is triple net leases, which pass the cost like insurance and maintenance to the tenant. That keeps Realty Income's cash flow predictable. And the second one is NNN REIT, ticker NNN. NNN REIT is similar with the portfolio around 3,500 properties. They also focus on triple net leases and long-term tenants, but they are a bit more concentrated in the US retail sector. Think convenience stores, restaurants, and auto service centers. Less international exposure, but solid stability. Financials. Now let's talk about the numbers. Both REITs have a long dividend histories. Realty Income has raised its dividend for over 25 years and pays monthly. NN REIT has over 34 years of consecutive dividend growth and pays quarterly. But more importantly, both companies have an outstanding track record of growing their revenue and revenue per share over the past decade, with only one down year during COVID. REITs typically aim for a payout ratio between 60% and 80%. I consider 75% to be healthy, but anything significantly above that starts to raise concerns about the long-term sustainability of the dividend. Both Realty Income and NNN maintain strong occupancy rates and carry reasonable debt levels for REITs. That gives me confidence that they will continue increasing their dividends year after year for the foreseeable future. The real question is, how much can they actually grow from here? Valuation. Now let's estimate a buying price to see if these stocks are undervalued. Just for the record, I do own both companies. Starting with Realty Income, their forward FFO is $4.26 and the current PFFO is about 13.5. Historically, this multiple has ranged from a low of 13 to a high of 23. In better market conditions, I'd expect a premium REIT like Realty Income to trade around 17 times FFO. Hopefully sometime over the next decade. Analysts are expecting about 6% growth this year, with slightly lower growth afterwards. Personally, I'd expect some ongoing growth just from inflation, but to stay conservative, I'm estimating 4.5% annual growth for the next 5 years and 3% per year for the next 5 years. And as always, I'm targeting around 12% annual returns. With these estimations, the fair value comes out just over $60 per share. On screen, you can also see a range of target prices and expected returns based on different scenarios. So Realty Income still looks like a solid buy, but only if you agree with these growth estimations and return goals. But as always, this isn't investment advice. Make sure you do your own research. Now let's do the same for NNN. Their forward FFO is $3.38 and the PFFO is around 12.5. NNN has historically been a more conservative company, with a lower leverage and lower payout ratio, which usually means lower risk but also slightly lower returns. Because of that, I'm using a more conservative fair value multiple of 16, which is a bit lower than what I used for Realty Income. Analysts are projecting growth of around 2% annually, which I think is reasonable for the next 10 years. Using those inputs, we get an estimated fair value of around $42 per share. On screen, you can also see other expected returns based on different prices. So based on this analysis, both stocks look fairly valued on today's prices. Realty Income might look slightly more expensive on a PFFO basis, but it offers international diversification, monthly income, and potentially more growth. NNN, on the other hand, is a bit cheaper, likely has slower growth, but provides more US-focused safety and stability. Final thoughts. But I get it, these kind of investments aren't flashy or exciting. They are not going to 10x your money overnight, and maybe they won't deliver huge returns. But I think too many people overlook one of the most important parts of investing: managing risks and focusing on safety. I think these two are among the safest REITs you can buy today. If you're looking for a reliable income with lower risk, both of these deserve a spot on your watch list, or even in your portfolio. Let me know in the comments which one you'd pick, or if, like me, you hold both. If you found this helpful, don't forget to like and subscribe for more investing breakdowns. And as always, do not lose money and safe travels. Bye bye.